Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Michael Pachter on the line. He is an equity analyst for Wedbush Securities, kind enough to join us today, even though he's a little bit under the weather. How you doing today, Mr. Pachter?
Good morning, Joel. I have to apologize if I have a crackly voice, but I'm actually going to be fine today. Thank you.
Okay. All right. First, I know you follow your individual securities very closely, but we kind of have an interesting market here, pressed up against all-time highs on the quad witch expiration. We've gone off pretty hard here, coming near the bottom of the trading ranges. From your indicators or your sentiment here, or we just in another trading range here, or things changing a little bit?
Not that I'm an economist or a market expert, but I have to believe that currency and the price of crude oil are going to, benefit some industries and hurt others. So consumers benefit more money in their pocket from lower gasoline prices and less expensive imports. I'm not sure what that means for the economy because obviously the dollar is very strong, which means we're not going to be exporting as much. But we're nearing full employment, so lots of good indicators for the economy, and people are going to have an average of $20 a week more in their pockets, which I think means that obviously wealthy people may not notice $20 in their pocket, but middle income and lower income people are going to definitely notice. So that should be good for consumer product companies, anybody who makes products that that the masses consume, and that's about half of my list. So, movie theaters are going to do well. Video game companies are going to do well. Electronics retailers, GameStop, Best Buy should do well. So I'm pretty optimistic that the market, at least for the stocks I cover, is going to continue to appreciate.
Okay, let's go right to some of the stocks that you cover, and let's start out with Netflix here. And had the incredible gap and go after earnings. I think surprised just about everybody. Made a monster run up over 475. Couple downgrades. We've pulled back, but it really looks like it's in no threat of filling the gap that you had from the earnings. Give us your take on Netflix.
I think Netflix is a great example of a story stock where the market ignores fundamentals and just decides that they love the story. And the market is often right about these stories. They see the potential for a company to be a giant. So I guess that was Apple with the iPod. So Apple transformed itself, and then again with the iPhone. I think that people see Netflix as dominating the consumption of entertainment. There's no question that the company is a well-managed company, and no question that their product is a great value, so consumers love them. I have a sell rating, and my sell rating is not because I think the stock is a zero and going out of business. My sell rating is because I think that investors have given Netflix way too much credit for their ability to thrive in that future world where we all cut the cord and we consume content over the top. I think Netflix will do fine. I think they will always be profitable. They're not going away. But I think that the market has discounted too deeply the potential for competition. And I think the market has discounted too deeply the will that the content owners have to make sure that they extract as much economic rent from providers like Netflix as they can. So ultimately, I think that Netflix will do great, but with a smaller footprint, fewer subscribers, because they will be forced to charge more. And as they raise price, I think they'll lose some subscribers. And again, not a significant number, maybe 20%. I think that investors need look only as far as the launch last week, PlayStation View, at $49.99 a month to see how much content costs. Because if everybody had access to content at low prices, PlayStation View would be under $10 a month, and it's $49.99. Now, I'm not trying to suggest that Sony is stupid and that they're going to pull a fast one on consumers and they're paying $5 for content and charging $50. What I'm suggesting is they're probably paying $30 or $35 for content and trying to make a modest profit. And the point is, a new service is paying a ton for content. Once guys like Sony start paying $35 a month for that content, how is Netflix going to continue to offer their content at $9 a month? It isn't going to happen.
Is there
So
any
my sell
level?
rating is
Yeah. Is there
go
any
ahead, Ted.
level you get interested in it though on the buy side here, or would it have to be a lot lower than it is now?
I have a $245 target, and I want to be fair. I and the rest of the sell side are pulling numbers out of our ears. We're not sure. There's no way for us to really correctly value the international opportunity. So, I read one of my competitors' downgrades recently, the Evercore guy. I think he did a very, very thoughtful analysis. It was a really good note. He valued the international operations at something like $120 or $150. I value them at $50 a share. Now, again, that sounds like not very much. I value them at $3 billion, and they're losing money. He's valuing them at something like $8 or $9 billion, and they're losing money. And it's possible that they'll make gigantic profits and be worth $50 billion, but it's equally possible they'll never be profitable and they're worth nothing. So, that's kind of the difference in how I value it versus him. My target's 245. His is something like 350. The stock is at 450. So that's telling you that the guys with buy ratings are valuing international operations at 10 or 15 billion. It's crazy talk. I mean, a business that doesn't make money, and I think that where the street has Netflix wrong is the street defines international as being a single place. Like there's a country called international, and Netflix has leverage because they're buying international content from one supplier. Not true. The negotiations in, Belgium are separate and apart from the negotiations in Italy and the negotiations in Norway. So they have to buy separate content under a separate contract, country by country. My view is each country probably requires a critical mass, good round numbers, of more than 1 million subscribers in that country. Netflix is in 68 countries, last I counted, and they have about 11 million subscribers. So they literally only have a couple of 100,000 subscribers in each country. They are not profitable anywhere except Canada, the U.S., and possibly the UK. And yet the street seems to think they're going to turn the corner in France, Germany, Italy, Spain, every country. And there's a lot more competition internationally than there is here. So I think the street has just got this one completely.
It's difficult. Okay, we want to cover some other issues here since we got you on the line. People have been turning a little bit positive on GoPro here. A big rally up off the IPO, came crashing down. Kind of consolidating here, kind of quiet. The street has been coming out to defend it as of late. Potential with Roku and being on that channel, and talk about some of the major sports teams besides hockey picking it up. Give us your take on GoPro.
GoPro is a real company with a real product and a gigantic first mover advantage. They branded really well. If I can isolate a single thing that they've done wrong, they haven't shown a lot of discipline with insider selling. And so, like many companies that have gone public in the last 10 years, they issued very few shares, and they had a lot of shares on lock, within a 6-month period after going public. And, I think that the biggest mistake that their CEO made was selling $9 million worth of stock when the lockup expired. I mean, he owns, a gigantic number of shares. So he obviously owns 40 million shares or something. But I guess he bought another house. And, I think that's a problem. People see insiders selling, and they take that as a signal that, the insiders have no confidence in the company. I don't think that's true. I think the opportunity with GoPro, and I think the street doesn't quite yet appreciate this, is that we are different from our kids. We adults, so let's just say people over 40, kind of grew up as voyeurs, but we're not necessarily exhibitionists. So it's a little odd to us to think that anybody cares if we capture every aspect of our being and take a picture of our breakfast and post it on Snapchat. That's just odd to us. Our kids are growing up, and I'll say everybody under 20, as exhibitionists. and there's a gap in between 20 to 40, probably some exhibitionists, some voyeurs, but it's different from the older people. So older people dominate the market. They're the guys who invest. They don't quite get GoPro. They just think it's another camera and anything can compete. Young people totally get it. They want to capture everything they do, and I think that GoPro is going to see traction the same way Facebook saw traction, Instagram saw traction, Snapchat saw traction. And I'm not saying this is a social media play. I'm saying this is a cultural shift where young people want to capture everything that they do and tell their friends about it. It's a new way for young people to communicate. And so I think GoPro is very much like Nike, where Nike says we're the authentic footwear for professional basketball players. Look, LeBron James wears them. And then every kid on the schoolyard wants them. GoPro is saying we're the authentic motion capture device for outdoor athletes. And young kids say, well, I want to take it when I'm out on my bike or I'm at the beach or I'm doing whatever I'm doing. So I think this thing is going to thrive. I think competition is weak. I think that they have the right price points, the right branding, and the social media opportunity could ultimately yield dividends. But I think initially it's going to be a source of free advertising.
King Entertainment, King Digital had that big pop on the earnings, hit $17, gave it all back, didn't quite fill the gap here. The maker of Candy Crush, give us first tell us what level you're on, and then second, give us your outlook on the stock.
I finished 890 on Candy Crush, which is as high as it goes, and every 2 weeks they add 15 levels. Unfortunately, I'm now so good at the game that it takes me about 3 days to get through the 15 levels that they add. So, I'm actually going back and replaying levels, so all my Facebook friends see my face as the winner of the most stars in that particular episode. Anyway, I'm glad you asked about King, because King and Netflix are an interesting contrast. King trades at under 2 times revenue, and at under 5 times EBITDA and under 5 times free cash flow. And Netflix trades at something like 4 or 5 or 6 times revenue and 100 times earnings, and they have negative cash flow. So here's Netflix, which I think has a ton of competition and generates no cash, trading at 100 times earnings, and then King, which generates 800 or 900 million a year in cash, is trading at under 5 times EBITDA. Crazy. The market is saying we don't like the opportunity that King has, so we're not willing to value it very much. And yet that market is growing like crazy, literally $4 or $5 billion a year, addressable market for King. And we don't like King's dominance and track record of delivering a ton of profit. So we're going to discount that down because we think it's going away. And yet we love Netflix, which generates no real profit, no free cash flow, and we're willing to pay a 100 multiple because someday they're going to dominate. I think that's crazy. I love King, and I think what King has done exactly the opposite of what GoPro did. They've had a massive lockup. They literally have 320 million shares. Only about 30 million are floating right now. 290 million unlocked, and not one insider has sold a share. Nobody. Now, I think they need to exercise a bit more discipline and release those shares 5% at a time every 3 or 4 months and lock themselves up and let the float increase. But I think there are really big investors poised to buy this stock when there's enough float that they can actually get a position. Big guys need to own $150 million position size, and that would be a third of the outstanding float right now. So nobody can buy it who wants to. If these guys lighten up the float, I think the stock goes straight up. So I think if investors see insider selling here and it's in an orderly fashion, I think the stock goes up, not down. I love this thing. I wish I could invest in stocks that I cover. I would put my own money in this thing. And the fact that I'm at level 890 on Candy Crush, I've been playing for a year and a half, and I am the best casual gamer you've ever heard from. If it took me a year and a half, it will take mere mortals 3 years to finish this game. And I think they've got at least another 3 or 4 years to go on Candy Crush. Everything else that they've released is working as well. their all other games generate more revenue than Candy Crush, and that's been growing. So I actually think King is a really great buy right here.
Hey, just give me a second here. I got to put my buy order in on the open here. You definitely have
I don't
made,
think you have to chase it. Don't worry about it.
yeah, you made a believer out of me on that one. You made a comment about the lower gas as a result of the oil prices and flowing into the consumer spending money. Are they going to spend it at Best Buy, BBY?
This year, yes. And, I recently upgraded from a sell to a neutral, and the title of my note was Throwing in the Towel for Now. I think that Best Buy has two pretty big tailwinds, so two benefits happening this year. One is that Radio Shack is going from 5,000 stores to maybe 1,500 out of bankruptcy. And so that puts a couple of $1 billion of consumer electronics revenue out there for others to grab. I would say reasonably Best Buy will capture 300 to 500 million of that. And since Best Buy is about a $40 billion company, that's probably around 1% positive to their comp. That's good. And the second tailwind, obviously, is gas prices, more money in people's pockets. That's when guys, go and they were going to buy a TV. That's when the average household splurges, and instead of buying a 32-inch TV, they buy a 40-inch TV, or instead of buying a 40, they buy a 50. And that upsell, you started to see that in the last couple of quarters at Best Buy. Their television category comped positively, and it's not because of 4K TVs, because they were able to upsell people, for that extra $100, get a much bigger TV screen. So I think that continues throughout this year. I think you will see a positive comp. The management is excellent. So, even though I had a sell rating on it, I've always respected management. They have managed to cut costs by over $1 billion. That's huge on a $40 billion sales base. And essentially the source of all of their profits is cost cuts they put in place. So this company went from on the verge of losing money consistently to making a lot because management prudently cut their costs. That will continue this year. I think it sets up next year for a difficult comparison because even if gas prices stay low, they've already got the positive comps, and there's not going to be another Radio Shack bankruptcy next year. But I think for this year, the stock works, and I think that Best Buy is a beneficiary of low gas prices and competitive failure.
Michael, we got 1 minute left here. You got a lot of stocks that you cover. You give us great commentary. You were pretty emphatic about GoPro and then also the King Digital. Is there anything else on that you cover that just looks like an attractive valuation here, good risk reward, something that investors should keep on their buy radar?
Pandora and Activision, and I'll give you 10 seconds on each.
Okay.
Pandora, I think most people appreciate the revenue story, and it's easy to see that if they deliver ads more frequently and then you put those ads more relevant, so higher mix of local, and they get people to listen more frequently because they move into the car, the revenue's going to work. People don't get the cost side, and I think that Pandora wins its copyright royalty board case. If that happens, I think this thing is a double or a triple. That just doesn't happen until late this year. Activision, I think, is probably the best position of the video game publishers to just grow faster than the market because they participate in the console market expansion, and they are dipping their toes into free-to-play and dominating so far with what they've released. So I love them. I think that stock is probably has 50% appreciation this year. So I like it a lot. Those are the two I would focus on.
Wow, thank you. Michael Pachter, he's an equity analyst at Wedbush Securities, joining us on Benzinga's Pre-Market Prep, brought to you MarketFi, giving us some great insight into the stocks that he covers very well. Thank you, Michael. Feel better. Have a great day. We'll talk to you again soon.
Okay.